Neither Better Trades or any of its personnel are registered broker-dealers or investment advisors. I will mention that I consider certain securities or positions to be good candidates for the types of strategies we are discussing or illustrating. Because I consider the securities or positions appropriate to the discussion or for illustration purposes does not mean that I'm telling you to trade the strategies or securities. Keep in mind that we are not providing you with recommendations or personalized advice about your trading activities. The information we are providing is not tailored to any particular individual. Any mention of a particular security is not a recommendation to buy, sell, or hold that or any other security or a suggestion that it is suitable for any specific person. Keep in mind that all trading involves a risk of loss, and this will always be the situation regardless of whether we are discussing strategies that are intended to limit risk. Also, Better Trades personnel are not subject to trading restrictions. I and others at Better Trades could have a position in a security or initiate a position in a security at any time.
Hello and welcome out to a bonus insights. And decided to put this together based on several questions from students asking for specific things. So I wanted to cover those questions in this format. Not only is it easier for me than typing a whole bunch of answers out, it's easier to explain, but the nice part is we get the visual along with the audio. So I think it's just a better format for teaching and showing stuff. So but then as I was looking for a quote, I debated whether to do this or not. I normally start off insights with some kind of quote, and I had found one that I liked, and I was about to go, and then all of a sudden this one popped up, and I went, whoa, I like that, especially considering it's the new year. We're just a few days, well, a week and a half into the new year, and I love this. New year means nothing if you're still in love with your comfort zone, and there is really no other place that your comfort zone gets challenged in the market. I mean, there's other places. I shouldn't say no other place, but not many places that challenge it like this. It is one of those things that the market is tough. It's brutal. It's unforgiving. It does not care how you feel, what you want, where you're going. None of that matters. In other words, it's not a living, breathing thing. It is, I'm not sure. I want to say it's a mechanism, but it's not a mechanism. It's just, it kind of is in a weird way. I don't know. It's weird. I'm just kind of thinking as I talk, which I do often. It is, in a way, a living, breathing being. It's not a living, breathing being, but it acts as if it is because it's based on living, breathing beings. It is based on the collective emotional response of the human mind. And so it is very challenging because just the mere fact of trying to figure out the human mind and why we do the things we do is kind of tough to understand. And I just saw a news segment a little bit ago about, and maybe this is a little off topic, but with it's just hard to fathom and understand. I'm still kind of wrapping my brain around it. With Sean Penn, who love him or hate him, it's my opinion is I'm setting aside. I mean, what I think of the guy doesn't really matter. But he did an interview for Rolling Stone of El Chapo, who is the most wanted drug lord in Mexico. Was at least until several days ago, and they caught him. He went into prison, then he got out, and now they captured him again. But he did an interview, and he talked about, and this is how twisted the human mind is. He went on a rant, or Penn made some statement about how he's just El Chapo's just doing business, and it's he basically only kills people that get in the way of his that interfere with his business activities. It's really a twisted thought to think that it's legitimate that if you have a disagreement or somebody is standing in the way of your business succeeding, that you can kill them. And to try to wrap your mind around that kind of thinking is virtually impossible. And the only reason I bring it up is because it's an example, it's a display of how we as human beings can justify away some of the most evil things in the world and think that it's okay. I mean, some people, to me, it's totally twisted. It is completely, the guy's absolutely insane. To be able to somehow rationalize and justify that it's okay for this guy to kill people because it just doesn't make sense. I mean, if somebody hurts my business, I can't go kill them. And let's be honest, there's people in the last several years in this entire industry that we're in that have hurt the entire industry. Practically destroyed it, quite frankly, with regulatory hocus pocus where I can't say this and I can't say that and I can't show you my live trades anymore. We used to do that. We used to trade live in workshops. Can't do it anymore because of regulatory. They've interfered with my business. Do I have a right to go take them out? No, hell no. Excuse my French. I think it deserves the emphasis, though. And there was something else he said. He went on some rant about this and that, and we as Americans are consumers, and because of, excuse me, because we're consumers, we're the ones that drive the demand for the drugs, which basically puts El Chapo in a position where he's just filling a need and filling a demand. Well, he's talking about consumerism, and he's railing on consumerism, when the reality is this man's gotten wealthy off of consumerism. How insane is that? The guy is ultra rich because he's an actor who sells his product, if you will, to consumers. And then he rips on consumers and saying that it's consumers' fault for creating the drug situation. I mean, to any of us that think in a normal, rational mind, it's just insane. You just sit back and you go, how can this guy even do it? But from my perspective, the way I see it and being fascinated by the human mind, is sit back and go, this is what people do. It's not normal. He's way off the freaking deep end. Excuse my French again, but he's way out there in left field. But if you bring it back to a relatively normal and you take the core concept of what he's doing, it's nothing more than justifying and rationalizing away bad behavior and trying to treat it, trying to convince himself that it's okay and it's acceptable. And he's convinced himself. Now, most of us, like I said, that are normal and rational and have good hearts and aren't evil, we don't do the things he's done. But if you equate that to trading, with respect to trading, we do the same justification, same rationalization. So the scary thing is, and this, I can't believe I'm about to say this, we do the same things with respect to trading that Sean Penn does with respect to El Chapo or anybody else, any other moron, evil dictator that he's defended or met with. He rationalizes and justifies it away in his mind as if, he makes it acceptable in his mind. And we do the same thing in trading. Oh, I can hang on to this one a little bit longer because of X, Y, and Z. And sometimes there is a legitimate reason. Sometimes there is a reason to bend the rules here and there. But the reality is the human mind is, to me at least, it's fascinating. And to look at it from an external point of view and then try to apply the core principles of why people do crazy things they do and apply it to why we do the things we do trading, I don't know, it's just something that always, it's just interesting. It's very, very interesting. So with that being said, if your comfort zone, getting back to the comfort zone part, which that was a long rant outside of the comfort zone, but we've got to learn to be comfortable being uncomfortable. Because trading is not a comfortable place. You can get to a point where you are more comfortable and you are calm, cool, and collected. But for the most part, there's always going to be that time where you're nervous or anxious, or maybe there's a pit in your stomach. It still happens to me. Even though I'm at a place where I trade in a calm, cool, collected area most of the time, there's still times where it's like, oh man, TripAdvisor that happened back this last summer. You buy an option for $5, you throw an order out for $5.40 thinking it's going to drop, everything's there. 30 minutes later, you come back and you're down $2. You go, what happened? The thing ran $12. Why? It's not a comforting feeling, but it's reality. And you learn to get comfortable being uncomfortable, and you get used to those types of situations and just accepting them. So with that, let's get on to the actual material. And here are the few things I want to cover in the next little bit. I have no idea how long this is going to take. I just spent 6 or 7 minutes ranting about something I didn't think about or plan on going on to. But sometimes I find squirrels, and sometimes I think sometimes things just hit my brain, and I think they're legitimate and they're worth discussing. So. But these are three different things, different questions that came in, or requests for specific guidance, information, whatever you want to call it. And the first one was, and I want to cover this because I think it is important, is one theory I still don't understand is the calculated entry. So let me get into, and again, this is why I love doing it this way, is because of the visualization we can do, can show you. So let's take, and I've got a few that I'm going to use for examples for, I think I can use them for all the questions. But with respect to, or you know what? I'm going to shift gears here. let's go find one. Let me go see if I can find one that does not have, and I'm just going to do this on the fly. And you can kind of see how things go. I got to find something that doesn't have a trading plan on it, though. And most of these do, and I'd like to find something that's good. Let's use this. It does not have a trading plan. And basically what you're about to see is just what I do as far as an analysis standpoint. And this one is going to be a stretch because I'm going to force some kind of trading plan in. And normally don't do that. I used to. One thing I've learned through experience is that it's easy to try to find something and see something that you want to see. You can create just about anything you want visually on a chart. Interestingly enough, this kind of ties perfectly into the whole Sean Penn thing. Sean Penn has convinced himself of this thing. He looks at the evidence and finds the evidence that he wants to convince himself of what he wants. And it's very easy to do the same thing with respect to the market. I can look at this and say, okay, here, there's already some lines drawn here. Let's see if they're in the right spot, because I know Extreme Charts is kind of goofy. I'm going to adjust this one because actually it makes more sense there. These might have changed. I don't know. The whole stuff with the Extreme Charts is interesting, but so those are some major points. You can see 106.80, 107.90. You can see the amount. Let me zoom it in here so it's a little easier to see. You can see the number of hits on these points. Of course, you got a little bit of breakthrough here, a little bit. So you try to find the best spot. And again, if you haven't heard this phrase, I think it's awesome. Something that I read years ago, and it hit me like a ton of bricks because I am very OCD, very detail oriented, and I used to be one of those that would put a support line or a trend line, and it had to be exact to the penny. And so when I read this, it really hit home because it was the opposite of what I normally am, and just went boom. And the saying goes like this, that a trend line or a support line, horizontal or whatever, should be drawn with a crayon and not a pencil. In other words, it's more of a range. You got to give it a little bit of wiggle room. It's not going to be exact. You can't be exactly precise. And so what I try to do is find the best spot, the most ideal. And right here, 107.90. You know, we could put it right at 108, but 107.90 is a little more accurate. Now, what we could do is say, well, look at where it's at, and there's a spot. And there is actually some pretty solid resistance there at that level. So we could actually have a legitimate spot to look at here. We could draw this line off here. That's, even though right now that's not relevant, so it really doesn't matter. In fact, I'm just going to take it off there. Oh, this is an iShares. Good. It's not a real example. I most likely wouldn't trade this anyway unless it was really significant. So what we've got here is, let's go through and look at, see if there's anything indication-wise. Ooh, it's below the 200-day. You got Stokes up above 80, crossing down. MACD looks a little bullish, actually. So kind of some mixed signals here. Excuse me. So let's just say that you wanted to trade this. Let's say that you were looking at it yesterday with a kind of sort of hangman that's there, and say, look, there's some resistance at 108.66. I'm going to zoom in here and make it even bigger. And just for visual purposes, we can see the volume doesn't really tell us a lot. It's not giving us any information, so I'm going to get rid of that. Now the question becomes, and I'm just going to go back and review this, make sure 130 still knows to calculate the entry. So to calculate the entry is, the first thing I do is the stop. Obviously, we know the stop and the target. So the stop in this example would be to put it slightly above, in this case, the high. So 108.72, slightly above the high of that day. Because what you can see, which also goes above this high, so all the way back in November was the last time it was here, and it crashed right through that number. It's tried 1, 2, 3, 4 times to come up to this 108.66 area. Twice, this one time it gapped just barely above it and then sold off. Here it rallied up there, but then sold off and couldn't stay above it. So it looks like a pretty good line. So we've got the stop slightly above the ultimate high. So if it breaks upward, if it goes against us, if we're buying puts, let's say, or doing any kind of bearish trade, then that's where I'm going to get out. Say, okay, if it breaks that point, I don't want to have any risk on the table. The next point is the target. Okay, where might it go to if it does drop? And the kind of obvious answer is right down to that support level, 107.90. So I always put it just barely short of it in case it doesn't get there. In this case, it's only 2 pennies. Sometimes it's a couple pennies, sometimes it's a couple bucks, depending on the stock. So now, quite frankly, figuring out the calculated entry, which is really extremely simple. And I'll show you exactly what it is. I'm going to break out the risk reward calculator. In fact, let me leave it there actually so we can see what the numbers are, and I'll just stretch it out here. And we will leave this on the big guys. Now there's two different ones. I've got the little guys, which is a 3-to-1. You see here's a 3-to-1 risk reward. So depending on what you're trading, and this really is open to interpretation, it's completely up to you. 3-to-1 risk reward obviously gives you a 25% chance. In other words, 1 out of 4. So if you have 1 out of 4 trades go in your favor, if you have $3 of upside, $1 of risk, then 1 for 4 you're going to be break even, or 25%. Now if you go to a 4-to-1, that gives you an advantage of 20%. So in other words, you can be 1 for 5. So if you have $4 of upside, $4 of potential profit, $1 of risk, if you lose on 4 trades, you lost $4. If you make money on 1, you made $4, you're break even. That's 1 winner out of 5 trades. That's 20%. In other words, you don't have to be right that often. Now on the higher price stocks, I use a 4-to-1 risk reward ratio. Generally speaking, anything over about 40 or 50 bucks, I'll use a 4-to-1. And sometimes you use a 4-to-1 on a little guy, and sometimes you may want to use a 3-to-1 on a big high flyer. It is variable. This is just kind of a baseline that I use. So what we'll do, I think it was AGG. It really doesn't matter. I'm going to make it small so I don't have to see it. So really calculating the entry is nothing more than a mathematics. That's all it is. And that's why this is really the simplest part. That's why I said it was simple. Is once I've figured out my risk tolerance, in other words, at what point am I going to stop out if it doesn't do what I expect it to? And then at what point do I want to take my profit? At what point do I think it's going to either stop or slow down to where it would make sense to take my trade out with the gain that I've got? So all I have to do now is punch in my risk. Whoopsie, numbers locks needs to be on. 108.72. So this is how I calculate it. I punch it in 108.72, 107.92. And it literally, I mean, the calculator was created so it does the math for me. I used to do this longhand, and I got really burned out because it was tedious and it took too much time. And so I'm dangerous enough with Excel to know how to create formulas, and that's about it, but basic formulas. And so now I have to do, I mean, that is literally how I calculate it. So what we can look at, and this may be not the greatest example because it's a small range, but it really doesn't matter. When you look to the right of the orange there, which is 108.56, which I'll plot in just a second, you look at the negative 16. So your risk is 16 cents. In fact, let's plot it right now, 108.56. I could double click one of these lines and duplicate it. 108.56, and we'll make it orange. Now, when I bring up the risk reward calculator, what we see is we've got 16 cents of risk with 64 cents of potential. Now, is that 4 times as much? So if we have 16 cents of risk times 4, 64 cents of potential profit. So in other words, we have 4 times as much profit potential as we have risk on the table based on the stock price. Remember, it will vary to a certain degree with options, but at the same time, options are nothing more than derivatives. They are the underlying below the surface of the stock, and they essentially will react and trade based on what the stock does. The only variable really we have with options is volatility, which can skew things one direction or another. Sometimes they skew them where it works against you, and sometimes it skews where it works in your favor. So realistically, I think long-term that evens out, so I don't worry too much about that. Reality is that by doing this, by calculating your risk reward, you now have a huge statistical advantage. You have the odds in your favor. Because how many trades does it take to make up for one loss? And I'll use this as an example. We'll do See, there's some big ones and there's some little ones. So it makes it hard. Sometimes with these high flyers, you get stocks like AGN, $300 stock, and it really kind of skews it. You can see most of these, you've got $1 to $2 of risk, if not a little less, and $2 or $3, maybe $4 or $5 of potential profit. But you get something like AGN that you have $3.34 and 13, and then you got 287, and that's IBM. Now let's just do it. I'm gonna. I don't know. I don't want to. I'm gonna make sure this one comes out as a loser and see what it looks like. So all I have to do, and I did this with the spreadsheet recently, where you can put in numbers and you'll see to the right where it calculates it out. And I don't know how this will turn out. So we're going to take the first one, we'll make winner, and we'll make the rest of them losers. And I'm just doing this randomly. I'm not. We'll leave that one we just did out. So you can see here where it calculated out profits and losses. And what you can see, some of you may have seen this already. So you've got a whole slew of losses and only 4 profitable trades. And I haven't seen this. I don't know what's going to turn out, but if you scroll to the bottom, watch what happens. Okay, so it tells you the percentage, and you can see right above the 18%. 4 trades went in your favor, 18 went against. That's only 18% accurate. Now here's the interesting part, is you've lost $3.98. Now to some people, they say, whoa, that's crazy, I don't want to lose. Well, think about it like this. You just did 22 trades. 22. And if you put, let's say you did 10 contracts each, if you did all of these and say over a 3-week period, if every single one of them triggered and over a 3-week period you did all 22-week trades, let's just say a 4-week, let's say a month, make it round. You're probably looking at between, if you did say 10 contracts, you'd be looking at between $50,000 and $100,000 invested, if you're with options. Because ABBV, if you're following the 70 to 90 rule or 65 to 70, whatever it is, you're going to be spending $3 to $5 per option. And some of these, ACE and AGN, they're going to be more expensive. So if you take an average price of say $5 per option, that's $5,000 per trade. 22 trades, that's actually $110,000. So round it off to say $100,000. Let's say you did all 22 of these trades. They all triggered, and you had $100,000 invested in the market. And over a month's time, with $100,000 invested, with 22 trades, only being 18% accurate, you were only down $398, or 4%. 22 trades on 100,000, you're only down 4%. A 4% loss is no big deal, especially when you're talking about trading in an aggressive manner, and you've done 22 trades, and you got 100. It's virtually nothing. Because the reality is, watch this. Let's switch it up and take, I don't know, I'm going to delete all these. And let's make the last one, because that'll do this one here. Delete, 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 delete. And the reality is we have 2 extras here that are both losers. That one should have actually been a winner right there. Oh, interesting. Let's go back to that. Let's go back to the way it was. Watch this. Because I took the first one of each. See, these are split into 5 sections, 5-piece sections. This one actually should have been a profitable trade if I was taking the first one. Now watch this. Oh, what do you know? Which obviously, we kind of know what's going to happen, but there's the beauty of it, is just one trade. Just one trade can flip you from down $4 to up $1.24. And the reality is, look at this. You're 23% accurate. Let's make this. Watch this. Make this one. And I was thinking about putting this one in, but let's make this one a loser. Okay. Now you're 22%. 5 out of 23 trades you were profitable on. 22% accurate. You were basically about a little bit better than 1 for 5. And you're still up $1.08. Some of you right now are sitting there going, whoa, some of you have seen this already. And I show this and I show it repeatedly because it is so powerful. And because so many people struggle, and I'm one that did too, struggle to recognize and realize and accept the fact that you can actually genuine only be 20, 25, 30% accurate and still make a profit. See, watch this. Let's take this one out. Let's actually make that a profitable one. Or let's not and say we did. Let's make that one not. And let's make this one. Let's take this one that's got a little bit better. Oh my goodness. And this right here is exactly why, and I'm going to point this out because I think it's so important. Notice all these little losers. And notice the winners. The lowest one's 266. You've got two trades over here. They're 287 and 334. Everything else is small, relatively speaking. Those are the only two out of all the losers that are bigger than the smallest winner. The other winners are big. This right here is the exact reason why cutting your losers short, cutting them off quickly, getting out of them quickly and taking a small loss is so important. Because when you do that, you take a whole bunch of little losses, just like this. Then you have one trade that goes for $10. Then you have another trade for 3, and then one for 355, and then one for 266, and then one for 4 and one for 5. The vast majority, 26% are winners, 74% are losers. But the losers are so small that even only being 27%, 26% accurate, you're up $7.50. And you go back to the same premise of having $100,000. If you did every single one of these trades and had $100,000 into there, and you're only 26% accurate, you're up $7,500. $7,500 being 26% accurate. 74% of the time you were wrong. And when this really truly sinks in, you go, whoa. That's when you start to stop caring about the little losses. It's when you just look at it and say, okay, so what? It hit my stop. Okay, get out. Because you know what? I did 5 trades. And here's the reality. I haven't run the numbers on it. I did 5 trades right near the end of the year. I thought things were setting up for a bearish move, but there were some trades that looked bullish. And I put on 5 different trades. Practice trades, of course. Right? But like I've told you before, I practice just like they're real. The first of the year, when the market started to tank, all the 3 out of the 5 were bullish trades. Got out of those 3 trades, all with losses. One of them a little bigger than expected. Well, see, wait a minute. No, 2 of those were losses. 2 of those were losses. One of them was basically break even. It was 20-cent profit, but essentially break even. So 2 of them were losers. One of them was essentially break even. So those were 3 bullish trades. The other 2 bearish trades, just took one out yesterday with a 40 to 50% profit. And again, I haven't run the numbers, so I don't know. The other one I took out on, let's see, what was it? Well, here, I'll just bring it up. I think it's on here. An NCR, there it is. Yeah, I think it was one of those 2 days. Let me zoom way in here. It was one of these 2 days that I got in, somewhere right in there. And then this day, not yesterday, the day before, this is live. So this day right here that it tanked on the 8th, or was that Friday? It was Friday, yeah. I took out a partial position, and this will lead into the next one of the next questions about stops and moving stops, and we'll cover this here in a minute, is it got to a point where I could double my money. I was about a double. It was the bid-ask spread was big. Well, you can see it's NCR. You can see right now the spread on this option is 310 by 430. Here's where, and this is what I like to do with the options. In fact, there's me. That's awesome. That is just pure craziness. $1.40. So I will plot when I put the option in. I'll plot where I bought it, right? And again, I got to reiterate, this is a paper trade. But if it were real, buy it for $1.40. And you know what? It must have been, because these were all, it must have been on the 30th. Because that's funny, because that must have been the day I bought it, because that's where the line is, and that's where the trade is, at $1.40. On 7. Whoa, I took it out. Yeah, I took this out on 1.7. Never mind. Apparently it was. Let's go back to that. Oh, that's right. It was this day, because it was hitting the target. It was actually beyond the target. And I went, should I get out or not? I mean, you know what? I've got a double. And the reason I know, because 280 is what I sold it for. Bought them for $1.40. I sold 2/3 of the position for 280. So I had all my initial capital back and then some. Actually, I had a profit regardless of what happened with the last option. Or the last piece, I should say. The last portion of my trade. And then it kept dropping. You see, yesterday it had dropped again on Friday. More, even went down even further. It's like, let's just go for a ride, baby. Let's just take this thing and see how far it'll go. Then yesterday, you know what? It was, I think, 280 by, or no, it was 310 by 380 or something like that. I think it was 310 by 380. The bid-ask spread was. I thought, I'm going to throw it out 350 and see if they hit it. And there's a trade right there that went off right at 350. Wonder who that was. So this is me right here, and then this is me right here, and then this is me right here. And to get back to the bigger picture of this right here, out of 5 trades, 2 of them I cut off. They went against me, took losses on them. 1 bigger than expected. Because that happens sometimes. It either moves really fast or it gaps, and it wasn't significantly more than expected, but it was more than expected. So with those 2 losses and the 1 break even, and then the 2 trades that went in my favor, one of them for 40 or 50%, and that one right there that I just showed you, that was, this is why I love trading some of the smaller dollar stocks. I mean, they're $1.40, but I sold them for $2.80 and $3.50. And they're worth, I could probably get $3.80 for them right now. Kind of kick myself for getting out, but at the same time, it is what it is, and it's how you manage the trade. So, I don't know. It was, I don't know what the numbers are exactly. I'd have to go back and run them. But let's put it this way. If you take the losses and the profits, I'm way, way ahead. With 2 out of 5 working out in my favor. 40% accurate. And it's way ahead. And there's the beauty. Imagine if you get good enough at recognizing the patterns and seeing the charts to where you can be 30% or 40%. Let's just take one randomly. Let's grab this one. There's 30% accuracy. And again, this is just random. I just grabbed one. Because realistically, over time, these are the kinds of things you're going to run into. You're going to have those bigger, the Lockheed March that gives you $10. You're going to have these up here like AGN, which sometimes just skews the numbers. But you've got IBM too losing $3 because you got $12 of potential. This is a decent little sample of what you will run into over time. It might take you a month or 2 or 3 to get through 22 trades, but if you were to do them and this was a good sample, then in other words, if you can get to where you're doing about 30%, if you're about 30% accurate, and you're sticking to the risk reward the way, obviously a 4-to-1, and you're using, let's say, $100,000, and again, I'm just using this as an example. If you're trading with $100,000 and you're 30% accurate, you're looking at a $10,000, $11,000 profit. This is where, and I know I've been just beating this, but if the risk reward and the probability and the odds thing hasn't sunk in yet for you with trading, and realizing how important it is, then I hope this does it. And that is the reason, because it takes a lot of people a long time sometimes to get it to sink in, to get them to go, wow. And the reality is when you start looking at it, you go, I don't have to be that great at picking the direction. I don't have to be spectacular at seeing the exact perfect pattern. What I have to be spectacular at, what I have to master is putting the odds on my side and having the discipline to follow that plan and having the emotional control and be able to manage my emotions to a point where it doesn't bother me anymore to take a loss. And the reason it doesn't bother me to take a loss is because I have completely accepted the fact that I don't have to be very good. It doesn't take a rocket doctor to be this good. I think I'm officially so far off the rails, it's not even funny. And I keep looking at the time going, whoo, I've been talking for a while. So let's get back to this. And I kind of touched on some of this. I'm going to skip that second one and I'm going to jump right to this because we've just kind of been talking about that. I was just wondering if you could spend a bit of time explaining how you adjust your stops through the life of the trade, similar to how you spent some time on option selection a few weeks ago. I did that. And I'll be doing that again. I'm going to try to sprinkle those throughout because doing it consistently takes time. And when I first started doing insights, I did that with every single trade, every single candidate. I went and looked and said, well, I look at this option and this option for every single potential candidate. And it really was overwhelming time-wise. I mean, I was doing recordings for 10 or 15 stocks that were going into an hour, hour and a half long. It was just too much. So it finally kind of sunk in for me that I need to either do that on a more sporadic basis or really because I'm a conceptual thinker. I like to look at and explain concepts and say, here's the big picture view and here is the core concept that you use. Now, every trade is going to be a little bit different, but conceptually, this is how you do it. And you have to modify and adjust on the fly. It's really kind of like driving. You have the core principles of driving. Not only the functional part, the mechanical part where you're doing, you're looking in your, the steering and the shifting and the braking and all that stuff. But then there's concepts of, making sure you're aware of your surroundings. And all the little pieces that go into driving, if you try to teach every single situation that you're going to run into and say, in this situation you handle this, it's not going to work because eventually you run into a situation that you haven't seen or heard of or experienced. So we have to look at things conceptually. And that's really how I try to teach and coach is that, here's the overall concept. Now, each individual situation, you're going to apply probably 90 to 95% of that concept to that situation. And then there's a small percentage of it that is variable. Some of it's going to vary based on what that unique situation has. So really, going back to, let's just look at that since it's fresh. This is an example that's perfect, NCR. It's perfect in the sense that, it kept dropping. And there is one question, and I'm sure that probably popped into some of your minds. Well, why didn't you just put a trailing stop on it? Or why did you get out of it? Why didn't you just put a stop on it so that if it does back up, then it takes you out? And that's a legitimate question. And there's no reason that I couldn't have. And in some ways, I wish that I would have, because right now, you look at it, it's 310 by 430. I can probably put an order out there for 380 or $4. 380 I'd probably get hit on, so I'd make another 30 cents. Maybe would even get hit on $4. And this thing just continues to fall. And if it drops down to $15, am I going to be a little bit cranky? Yeah. Let's just be honest. I'm not going to be happy if I got out at $3.50 and it's going for $6 now. At the same time, I have learned through experience that sometimes it's better to try to maximize and capitalize on a move like this and squeeze out. I hate to say squeeze out, but yesterday it was 310 by 380. I thought, if I throw it at 350, I really didn't expect it to hit right away, but it did. It hit literally instantly. The second I put the order in, boom, it took it. I went, whoa, that was not expected. But let's look at it realistically. Let's just say today I'm looking at it going, okay, I could probably realistically get 380 for it right now if we're using this. Okay, so I would have gained another 30 cents. Okay, so another 7-8% gain. Or it could have taken off to the upside, and then I would have given back some money. Maybe instead of getting 350, I would have gotten 320. So now we're looking at two different possible scenarios and say, okay, those are basically washes of each other. The only other possible scenario that really makes any sense that's any good is that, okay, this thing keeps dropping like this, and I move the stop, and I have a trailing stop, and it continues to fall. If it continues to drop from here, and I leave more and more money on the table, then am I kicking myself? Yes and no. But the reality is not really, because 110, 115% trade for a week and a half, I'm perfectly happy with. Now, if it would have been 300%, will I be a little cranky? Yeah, it's going to affect me. I'm going to think about it. It's going to be like, but so be it. And you know what? There's no reason that I can't go find other trades too. But here's the reason. Here's the reason I took it out. Because what I've learned over time is that, well, there's a couple reasons. This is one, is when you go back and look at the history of this stock, let me make this bigger. We've got and this was actually the main reason. And that is, you've got a round number of 20. And when you look at, let me make this a line chart real quick. Where did it go? I don't even remember where that's at. Is that it? No, that's not it. I use all the, I don't even use the, I never even changed this to a line chart, so I'm not even sure how. Where do I go? Oh, well, I'm not going to worry about it because realistically you can see it anyway. But you see right there about 20, you see all the old resistance back here in 2011? Then it broke out and it used it as support before it launched and ran to 42.50. So it's coming down, it's crashing to that point. And you notice that when these things crash, they don't usually stay down too long. They usually have a massive short covering rally. It bounces very, very quickly. In fact, let me zoom this in even more. You go back here where boom, it accelerated to the downside. What happened? Yeah, it dug in, it had a few days, and then took off and rallied. Here's another big gap to the downside, took off and rallied. Here's a more of a similar type of scenario where it dropped from 35 all the way down to 22. And I'm going to guess, yeah, that's earnings related right there. Oh, I love this. I didn't even notice that. Extreme charts, it pulls the earnings thing off. These keep it on there. Oh, that's awesome. I just noticed it. Wow. See, we're always learning. But every time this thing crashes, and you can see back here, I mean, just more recently in September when the market crashed, it dropped from 27 down to 22, $5 in a week and a half, and it bounced almost instantly and took off and rallied to the upside. Now, is that what's going to happen here? I don't know. It could just keep crashing. But statistically speaking, and when we talk about odds, the odds are that it's going to bounce. And so am I going to probably leave a little bit on the table? Yeah. You know what the reality is? My target was 22.50 and it was down at 20.70. I'm already making more than I expected. And so if I miss a little bit, if I leave a little on the table, I'm okay with that. Because the odds are that the further this thing falls, more violently it's going to bounce to the upside. Because anybody that shorted this thing up in here in $26 and now it's at 20, they're going, I got $6. That's 30%. That's actually about 60% profit. I'm going to run. And that will create such a strong updraft with the short covering and the move into the stock because people are going to think it's a good deal. Then it's probably going to move very quickly to the upside. So I'm perfectly content missing a little bit of the downside, leaving a little bit on the table to maximize my profits. That's really the thought process behind it. This should be blue, actually. So let me shift back to extreme charts. I had actually several examples of these to go through and look. I think I had 4. And there's the beauty is, I mean, there is no right or wrong answer. And it is one thing that is so easy to do, not only in trading but in life. To get stuck in this idea that there's a right or wrong. And I kind of hesitate to go here, but I'm gonna do it. One of the things, because I am very, just knowing myself, and it's one of the things that the market has taught me. I've learned so much about me and how I operate and how I think and the things that I do that reflects not only in my trading but has reflected in other areas of my life. And I used to be so stuck on there's a right way to do it and a wrong way to do it. It's black and white. There's very little gray. It's all black and white, mostly black and white. And there are certain areas of our lives that doesn't work. trading from a professional standpoint is one of them. But on a personal level, one thing I've learned that there are a lot of things in relationships, and I know that I have mentioned here, in the past at least, and maybe some of you are newer here, but I went through a divorce a couple of years ago, and it is pure hell. No other way to put it. If you've ever experienced that, then you know what I mean. It is not fun, and relationships are tough and they're hard. One thing that I've learned though is from the market is that there isn't necessarily a right or wrong. Just like there aren't in relationships. Just because one person feels a certain way or thinks a certain thing doesn't necessarily make it right. If it's something that's opinion based or subjective, there is no right or wrong. The only things that you can really look at and say this is right and this is wrong are factually based deals, or things where there is significant statistics to prove, maybe not say that it's factual, but the theory or the reality behind it is that this is the way it is. I mean, this is what works. And that's kind of the way trading is. When it comes to tactical analysis, when it comes to where to put your stop, where to start with a stop, where to move it, how to handle each situation, there really is no right or wrong. And it's so easy, and it's not uncommon for people to come in, and I see it all the time as a coach, as an instructor. People ask certain questions, and I can tell what they're looking for is what's the right way to do it. Just give me the answer. Just tell me exactly what the right way is to do this in this situation. And I might be able to speak to that specific situation, but the reality is that every situation is different, just like in a personal relationship or relationships with your kids or business relationships. Every situation is unique and different, but when you have core concepts and core principles to work with, then you use those and you stick to those core principles and core concepts, and 90% of what you do is based on that core. The other 5 to 10% is subjectivity and kind of tweaking and moving things around and adjusting according to what the core says. And so as much as I appreciate the questions and asking, okay, how do I handle this? There really is no right or wrong answer. So what I'm about to say and show you, and a lot of the things we've talked about, almost everything we've talked about here, just remember that it's subjective. And just because I say this is the way I do it or this is one way to do it, doesn't mean that it's right or wrong. It just means it's the way I see it. It's the way I handle it. And if you want to pick up, the way I do things and do it exactly the same way I do it, have at it. If you want to tweak it and adjust it to your personality and what you're working with, that's what I would do. If you're working with $500 or $1,000, then you may have to tweak some of this stuff. You're going to have to probably take a bigger risk. Excuse me. If you're following the 10% rule, it's a little hard with you got $1,000, $2,000. You can do it, but it's more challenging. You might want to change that rule for a time. But the reality is, take this BPL for example. So let's say, okay, you set up this trade, and this day was 4 days ago, the 6th. One of my best friend's birthdays. Let's say on the 6th you enter that trade. It hits your entry point, you get in, and you're like, all right, good. It drops, you can see what it does, right? You get in 63, it drops down to, what's the low of that day, 61.44? So if you're sitting there watching, you're up $1.50, you're like, woo, keep going. And then by the end of the day, it rallies up about $1 and you're starting to kind of worry. You're like, oh man, I don't like this much anymore. Because it's always fun to get into a trade, right? When, like this big day right here, gaps down, let's say you get in first thing in the morning, it's $59, and it hits 54.20 later, you're up 6, you're like, woo! And then it pulls back a little bit and you're freaking out. You're up $5, and it pulled back 30 cents, and you're panicking like it's the end of the world's coming. Like, just settle down. You just made $5. What are you worried about? Whatever the number is. But we get all excited, and then as soon as it comes back and it does something normal, we panic and freak out. When the reality is we need to learn to look at this and say, okay, that's normal. Stocks don't, a big giant drop like this doesn't happen often. And when they do, they usually bounce shortly thereafter. And you see what happened here. It gapped open the next morning. in which if you were in that, you're freaking out first thing in the morning. You're like, oh my God, it's gapped up. It's going to take off and run. It's going to take all my profit back. And then it drops off again down to 52, gives you maybe another couple bucks of potential. And this right here, looking back to NCR, is exactly why I try to maximize it. It takes it out here, and then it rallies by the end of the day, and it's back up at 54. And 2 weeks later, it's back at 64. Sorry. See, I've been talking too long. Now this cough's getting worse. My throat's getting tickly. So anyway, we've got to learn to realize and recognize that these types of movements are normal. And stop panicking about it. Don't freak out about it. Because the stock vacillating, going back and forth, and especially when it sells off a bunch, it's liable to bounce a little bit. And we have to learn to stomach those. They're not necessarily fun because we'd rather it just tank and keep falling without stopping. It's just not the way it works. So we've got to learn to endure these kind of back and forth vacillations. So it bounces back up. The next day, it gaps down, and you're in a good mood. You're like, woo, we got a gap down. But then, of course, what happens? It looks like, and we'd have to go back and look at the intraday chart. For time's sake, I'm not going to. But most likely what happened here, based on almost 16 years of experience, is it gapped down and then bounced and rallied back up to that 63 level. So that's where you're like, you were up $1 first thing in the morning, and now you're break even an hour later, and you're kind of freaking out. You're going, oh, no, this isn't good. But by the end of the day, where are you at again? See, this is not an emotional roller coaster ride you go on. So you're at 60.47. So you're up, it's up $2.50 from where you got in. So what do you do at that point? And the reality is this, and here is where I'm going to get to a core principle. And if you want to write this down, have at it, because I think it is very important. The question to ask is, where am I at emotionally? You got into this thing yesterday at $63, let's just call it. It's now at, let's say, 61. Stock has dropped $2. You bought puts, let's say. You're up $1.50 on your options. Now, some people, in the old days when I learned how to trade, a lot of people would do this, and they'd go, man, you paid $6 for those options. You're up $1.50. Take your profit. You got 10 contracts, man. That's $6,000 into $7,500 in a day. Take it and get out. And a lot of people I know did that. That's the way they traded. And there's nothing, I can't say there's nothing wrong with that, because there is something wrong with that. Because you're cutting your winners short. And eventually you have one that doesn't work out this way. It goes against you. And you take a $2,500 loss. That little $1,500 win doesn't make up for a $2,500 loss. But the question to ask here, and let's just say we're on this day right here. Okay, we got in the day before at 63. You're up $1.50 on your option. Let's just say you have 10 contracts to keep the math easy. So you're up $1,500. How you feeling? Pretty good, right? And you're going, woo, it's at 61. It's got another $6-7 to drop. Man, I could make $5-6 on this thing. Woo! And you could. The question is, where are your emotions at? Are you worried about your $1,500 profit? Are you thinking about it and considering it and saying, I don't want to give up my $1,500 profit? I'm really worried about it. The feeling is that I want to take it. And the truth is, your feeling is your feeling. It's going to be there regardless. And now we're getting into that realm of managing your emotions. How do you feel about it? And if you're nervous and anxious, then it might be time to do something about it. Not might be, it is. If you've got 10 contracts and you've got $1,500 of profit and you're worried about it, and you look at it and say, you know what, I still got $6 or $7 of potential. I don't want to take it out, but at the same time, I don't want to give back my profit. Then what you have to do is say, how scared am I? How much fear do I have? And where would I be comfortable? At what point can I scale back on this position to feel comfortable? And for some of you, that might be taking out 2 contracts or 3 contracts. Let's say you scale it down to 7 contracts. You take out 3. You sell 3 contracts. You bought them for, let's say, 6. You sold them for $750. Okay, let's do some quick math here. I'm literally winging it here. a lot of this stuff I didn't even plan on touching on, and I'm rambling forever. I see I'm almost at an hour, so I hope you're still with me and having fun. I'm having fun, so that's all that matters. So let's say if you paid $6, so you got $6,000 in the trade, okay? And if you take out 3 of them at 750, so 750 times 300, that's 2250 minus 6,000. So now you're in the trade for 3750. That's out of your initial investment. That's how much is still on the table. 6,000 in, you've got $2,250 you just took out. You got 3750. You still have 7 contracts left. Whoops. Okay, then we divide that by 100. So your cost basis on the other 7 contracts is now $5.35. $5.36. Okay, whatever. You paid $6 for them. They're now trading at $7.50. You sell just 30% of your position, 3 of them, and what you have effectively done is dropped your cost basis to $5.35 on the 7 contracts that you have left. It's trading at $7.50. Your cost basis on the option per contract is $5.35. That's $2.15. Where does this stock have to go approximately for the option to be worth $5.35? The reality is if you paid $6 for it here at 36, it would probably, I'm going to guess somewhere in there, 63.50, 63.70. So you've just gone from a point where you are right here. The stock is right down here at 61, just a little below 61. And because you scaled out of 3 contracts, it's now got to jump to about 63.50. Let's move it down there a little bit. Didn't really matter that much. It's got to jump about $3.5, $4 before you are breaking even. So now let's look at one more scenario just for the heck of it. Let's say you take out half your position. So you had $6 you paid initially. You're up $1.50, so it's a $7.50 times 500. That's $37.50 minus 6,000. It's $22.50 divided by 500. You got $4.50 is your cost basis. So if you took out half the position, your cost basis on the other half the position is now $4.50, which makes sense. You got $1.50 profit. You take that off the $6, it's $4.50. So the option's trading for $7.50. Your cost basis is $4.50. It's now got to move backwards. The option has to move backwards $3, so the stock would have to move back about $4 to $5 before you're breaking even, before you start to get in the red, which means you'd have to go back to almost your original stop. So in other words, one way to view this, one way to look at it, to perceive it, if you will, is if you get in a position like this, you get in at 63, the next day it's at 61, and you got $1.50 of profit. You take, and obviously I'm winging it on the numbers, but if you take half of it out, you can leave the original stop there and be about break even. Now, if you do that, where are you at emotionally? Where's your mindset? You're just relaxed. I mean, this thing's got to make a pretty massive move to the upside before you even get into the red. And now what that allows you to do, and as you can see, and this is current time, I mean, it's the 11th. I'm not sure what it's doing today. We could update, but I'm not going to worry about it because I don't even want to update it today because I want to look at this as a conceptual thing. You're now in a position, by scaling out, you're only, what are you, 20, 25% of the way to the target, but you've just put yourself in a position where now you can relax and let this thing just do its deal. You can give it the room to wiggle because the next day, if you got out right there on that day, the next day when it gaps up a little bit and takes off running, are you flipping out? No. It's at 62.70. I'm still profitable. Let's just go with the scenario where you took half the position out, which is the more conservative one. You're still in a profitable position. You don't care. You're going, hey, we're not even back to my original entry point. Even on this other half, I'm still up 30 cents. Sure, I gave back $1.20 of my profit, but who cares? And here's an idea. What if you looked at that and intraday it started to show signs that it was going to head back down? It gets up here to the top of this candle somewhere in there, then gives a nice little topping pattern on an intraday chart. And you say, you know what? I can pick those. I sold them yesterday for $750. They're now going for $650. I can buy those back. Or maybe I can pick up 2 more of them. Maybe I have 5 contracts and I throw 2 back on at $650. And now if it does what I originally thought and it continues to fall, then I even got more leverage. But let's just stick with the example of, okay, you just had 5 and you stuck with the 5. And you were just sitting back just chilling and going, okay, I don't have to worry about this thing. Let it go. And then by the end of the day, what are you feeling? That day, not the last candle, but this candle right here. You're like, whew, man, not only am I glad I took out half the position because it allowed me to endure that retracement back to the upside and not panic, but now I'm still in a great position. I'm up $1.30 or so. And then yesterday, what happens? Boom, it's down $2.69. And that $1.50 profit is now $3.50, $4 of profit. And you're halfway to the target. You're like, woo! But here's what'll happen. Let's be real. You'll go back and look at this day right here. And you took out 5 here, right? You took out half the position. You go back and look at this day and say, man, I should have picked up more. I should have gotten back into the other 5, or at least a couple more. I should have bought 2 more at $650 there. Woulda, shoulda, coulda. Don't worry, it'll happen if it hasn't already. But now the question becomes, what do you do here? Stock closes at 58.32. It actually intraday gets down to 57. You've now had a $6 move in 4 days. You got half the position on the table. You are about 2/3 of the way to the target. What do you do? And there are so many different ways to handle this and say, I'm going to do this, I can do this. Well, you could take the rest of the position out at 57. You could just say, you know what, I'm happy with my profit. I'm going to get out. You could move the stop, in which case you could say, okay, let's, and this is what I always do. I make it a dash dot so I know that it's not the actual original stop. You could say, you know what, I'm going to move my stop down to, it really varies. I mean, some people might say, I'm going to put it to about halfway of the day's range. Okay, so 59.32. I'm going to put a stop there on the other half the position. So if it crosses this point, then I'll get out and I'll take my profit. That's one way. And again, this is conceptual. There's lots of different ways to handle it. You could, and some people that are a little more risk averse might come up and say, okay, well, 60 is a round number. I want to put a little bit above that. Plus, I want to put it on the upper end of the candle. Could put it way up there. Some people say, I'm at 57, man. I want to protect those profits. Like, man, I'm going to put it right there. And you get stopped out at 57.32 on the 5 contracts, and then, okay. And it rallies back by the end of the day. Is at 58.30. You capture an extra. At the end of the day, you're feeling good because, hey, there's an extra bucket took off there that I saved. I ended up getting out of 57.32. It closed at 58.37. I feel good. And there's nothing wrong with that. And then another way to do it is if you're watching this thing intraday and you see it and it hits 57, it starts to bounce a little bit. You could say, you know what? Let me take a couple more contracts out. Let me take 2 more. Maybe you're up. Maybe your $6 option is worth 10 now. If you take 2 more out, let's see, we had a cost basis of what? We got, we took half out at 750, so 3750 minus 6,000, 2250 cost basis. If they're now worth $10, if we sell them for $10 when it hits 57, that's $2,000. We had 2250 minus $2,000. That's $250 left. You took 2 contracts out of $10. You've got 3 contracts left. Divide that by 3 contracts. Your cost basis is now less than $1 on 3 contracts. It's 83 cents. What exactly are the odds of you taking a loss on this? Virtually 0. Notice I keep going back to odds. The key, in my opinion, is to get into a position where your odds are so high of coming out as a winner that they're virtually zero. The higher you can get your odds of coming out in a profitable position, the better off you're going to do long term. Hence the reason I scale. Because this is the perfect scenario for that, because you get a move like that, you can take a buck, buck and a half out of it the next day and put yourself in a position where you increase your odds the very next day, or preferably even the same day. You increase your odds of having a profitable trade no matter what happens, barring any kind of craziness. So what some people might do here is say, okay, it bottomed out, it's 57.32, I'm going to take out 2 of my contracts. Maybe you put a stop. Maybe you put a trailing stop on 2 contracts. You could put a trailing stop on things. You could do so many different variables, so many different ways to look at this. But really, the core concept for me, the core idea is this. How do I feel? Where are my emotions at? And what can I do? What decision can I make? What adjustment can I make to this particular trade based on the situation and the scenario to make sure that I can keep my emotions under control, to make sure that I don't panic and freak out? And if I am panicking and freaking out, and if I'm fearful and I can feel that and I know it, I need to do something. So adjust the trade accordingly to that. So while, going back to the question of, and really it kind of addresses this, is how do you adjust your stops? I adjust my stops and I scale according to my emotions. Because going back to the core principles that are absolutely necessary to succeed in this market, it is about managing your emotions. And no matter what's happening out here on the periphery, the thing I need to focus on and stay disciplined on is managing my emotions. And so stops, trailing stops, exiting positions, adjusting, scaling, all of those different external concepts all come back to the core concept of managing my emotions. Odds, my goodness, odds are all about managing emotions. So all these things out here, again, I'm going to reiterate this because I think it's important, and I don't know if I've ever verbalized it like this. I know in my mind I see it, but everything comes back to managing your emotions. And every single concept, from scaling to odds, is an external and outside thing that says, okay, here's why we do this. Here's why we use odds, because it allows us to manage our emotions. Here's why we scale, because it allows us to manage our emotions. Here's why we choose to move the stop. Here's why we take our position out at this point, because it helps us manage our emotions. And that just gave me an idea for a visual that I think I might use. I'm going to make a note so I don't forget. And this is why I love doing this. Because sometimes just going through this, and this is why I love doing this bonus stuff. I mean, I'm at 100 hour and 7 minutes right now. It's freaking me out because I'm going, this is way, way longer. I plan on 20 to 30 minutes. And if you can't tell, I love to teach. Absolutely love to teach. It's so much fun. And not just because it's fun seeing the aha moments and helping other people get to where they want to go, because a lot of times I learn stuff myself. And really that is one of the things I love about it most, because the realizations I have. Because everything with respect to trading is about managing emotions. Everything else is just external. And so I know it was kind of weird last week. I felt a little odd talking about it, but in the market mashup, I brought up this book about shame and worthiness. And that's something that gets into some pretty deep emotional stuff. And the reality is that, in my opinion, to succeed in trading long term, you have to look inward, and you have to be willing and have the courage to look at your emotions and recognize them, and learn to recognize them, and learn to feel them, and learn to notice when you feel fear. And when you do feel fear, and when you feel some type of an emotion that makes you want to make a decision, you have to make a decision to deal with that emotion. It's really no different than regular life. Things happen in life that bring up certain emotions. We have this program and we have these things in our minds that are all centered around, there's all these external things that happen, but really it comes back to the core of dealing with emotions. And it's no different in regular life. And it's one of the reasons that I use examples from regular life and I use just regular normal life stuff in my trading and in my coaching. And I do sometimes use some of my personal stuff. And even though it's not necessarily the most fun thing to talk about, it's reality. And it's funny because I really only once or twice have I opened up here and talked about my divorce and going through that. And I mean, it's absolute hell. And as much as, I never, ever in a million years expected I would ever go through that. It wasn't my decision. I fought like heck against it. I tried as hard as I could to, but you know what? One of the lessons I learned through that was that I don't have any control. The other side made their choice. There's nothing I can do about what she decided to do. I had no control over it. And no matter how much I wanted to control it, and I mean, quite frankly, tried to control it, the more it worked against me. And it's funny as I say this now, because I hate to say I've learned my lesson, because sometimes I don't feel like I have, but it's the same thing in the market. We fight against the market thinking that we can control it, thinking that we have control of things, and we don't. We have control over what we do and our emotions, and that's it. The outcome of any particular trade is completely outside of our control. It's funny because, and now that I'm talking about this whole divorce thing and everything, it's been a couple of years, and I've got a girlfriend now, and she's awesome. Super smart, and she is very emotionally aware, if you will. And she'd kill me if she knew I was saying this. She's had some struggles with her career recently, and it's funny because just yesterday I was thinking, she was fearful. Fear was kicking in, and she was worried that a simple mistake would end her career, or at least with that particular company. And I was thinking about it. I went, you know what? And I kind of wanted to say something, but guys, if you're listening, sometimes women don't need solutions. And that's one thing that I've had to struggle with, is that I'm a solutions guy. I mean, Patterson Flash was a solution to a problem that was for me. And as guys, we're fix-its. I mean, that's what we like to do, is fix things. And I'm so far off the rails now, but I don't care. So we like to fix things. And so in my mind, I'm like, okay, I want to give her a solution and tell her that, here's the issue. But it's like the way I'm thinking about it, I'm going, she's all freaked out and worried about this, afraid that she's going to get fired because of a mistake that was made, when the reality is that she has no control over that outcome. She doesn't get to make that decision. So she's got all this fear here surrounding somebody else's decision, when the reality is all she can do is focus on herself. She's awesome, absolutely amazing at what she does. And she's one of the best in her field. And she's freaking out and worried and stressing about something that she had no control over. The only thing she can do is show up and give it 100%, do all she can. The outcome of what happens isn't in her control, yet she's stressed and worried about and freaking out and fearful over something that she has no control over. That outcome is something that is somebody else's decision. And trading's no different. What happens with a particular stock, the outcome of the trade isn't within your control. The only thing you can control is the decision that you make inside that trade with what you have in order to manage what you are dealing with. I hope that makes sense. In other words, you can only manage your emotions, and freaking out and panicking isn't going to do anything. Managing your emotions and adapting and adjusting and doing what you need to manage yourself and your emotions is the best you can do. The outcome is outside of your hands. And it just shows, I mean, most of us are like this. We want to control the outcome. I wanted to control the outcome of my marriage, and I didn't have control over it. It was totally in somebody else's hands, just like our trading is. Just like you might have a job that's totally outside of your control. The outcome of what happens in your career or your job could be in somebody else's hands. And once we learn to accept that and relinquish control and let somebody else make the decisions they're going to make and just focus on us, just like in trading. Focus on your emotions, not somebody else's. Don't focus on what's happening in the market because it doesn't matter. Focus on what you have to do to control yourself and your emotions, and then things start to fall into place and you stop worrying and you just get calm, cool, and collected. You just relax. And then you know what happens? Trading becomes fun. Because you can just go have a good time. Because you know where your focus should be now. And your focus should be on managing your emotions, not this other stuff that you can't control. Now I think I probably addressed this. In fact, I think in a lot of ways I did. I said I'd come back to this, and I've been rambling what seems like forever. So this is the last question I'll touch on. I think I probably pretty much answered it. We could take probably one of the 50 million things I've already said and use it. But several times during your most recent insight video, you mentioned possibly missing the entry. Why can't we enter the trade once it passes your designated entry, especially if the trade is carrying the stock price in the desired direction? Is there a greater chance of incurring costs versus profit? Just wondering. And it is a good question. And it really kind of goes back to, take this one for example. And I plan on, these other ones I have checked, I was going to use as examples, but I don't think we need to go there because I think the concepts are there. Let's say the entry point's here at 63.06. Well, you've got another point here at 61.70. So let's just say you missed that. Get this jumpiness going. Could you then take it and say, okay, I'm going to move, I'm just going to duplicate this. I don't actually want to move. Well, I guess it doesn't matter. Could you take it and say, okay, I'm going to move this down to here? Could you leave the target in the same place and then maybe adjust this? I'm not sure what the number would be. And for time's sake, I'm not going to throw the numbers into a calculator. Let's do that. It'll only take a second. Oh, no, it's different. Yeah, I'm not going to worry. That's probably about right. I'm just guessing. I just dropped it in there. But you can see it's a little too cluttery. But if you move the stop down, if you missed it on one of these 2 days, you missed a 63 entry, could you move it down and place a stop here above this and then adjust things accordingly? Yeah, you can. And it really comes back to, that question. Let me just, there's something that says, I just need to read it. Enter a trade once it passes your designated entry. If we go back to the core deal of managing your emotions, what's one thing that allows us to manage our emotions? Risk reward, right? Having the odds on your side. Making sure that you're not taking too much risk for the possibility that's there. If you've got $1 of risk and only 50 cents of profit potential, you can see how the numbers work out. Not very good. That's why I'm not a big fan of spreads. If you get a $5, I haven't done spreads for so many years that, these little 50 cent and dollar spreads aren't common. But in the old days when I started, you have a $5 spread. That was common. If you got a $1 credit on a $5 spread, that was a great rate of return, right? You got $1 probably, you got 25% rate of return if it works out. The problem is that if you do 5 different spreads and you have 4 of them go in your favor, and 1 of them goes against you, you break even. So you're right 4 times and you're wrong once, and you break even. So that's 80%, right? You're 80% right, and you're still only break even. You're not making money even being right 80% of the time. You got to be right more than 80% of the time on spreads in order to make a profit. I don't like that. Now, there's different ways to tweak it, and you can say, well, you walk in with a 2/3 chance of making a profit, or 70%, depending on how you want to look at it, because the stock doesn't have to move, right? If it stays, for example, this one, if it's at $60, if you did a 60, 65 bear call spread, as long as it stays below 60, you're fine. So it doesn't have to go the direction you want it to. It can stay the same. It can go down. It can even go up a little bit. And you're still profitable. So you walk into the trade with a high odds advantage of making a profit. But the reality is still that if you're wrong once, it'll wipe out all the other little trades that you had. That's why I don't like it. That's why I don't like spreads. And there's different ways to tweak them and this and that, which just gets hairy, and I've tried it, and it gets too chaotic for me. I like simple, neat, clean. Buy, call, buy, put. You're in, you're out. Here's your stop. Bang, bang, bang. But the question comes back to that odds. Could I get in after it's broken to point? Yes. In my opinion, you have to recalculate the odds. You have to look at the pattern. You have to look at what's going on. You have to look at the situation, that scenario of what is the stock telling us. If it looks like it's going to keep falling, then fine. Just readjust your trading plan. Keep the odds on your side because that's what helps you manage the emotions. And at the same time, gauge your emotions. Where are your emotions at? Okay, I'm adjusting the trading plan. There's not as much profit potential here. There's a little more risk. So do I really want to do 10 contracts? Would I be freaking out if I did 10 contracts? Would I be panicking? Would my fear level be too high? And if the answer to that is yes, then one thing you could do is say, okay, I'm too scared to do 10 contracts because it's already moved a bunch and I think there's still more there, but I don't want to take too much risk. So in order to avoid that risk or in order to mitigate that risk, instead of doing 10 contracts, I'm just going to do 5 because then I won't be as scared or nervous about the trade. Heck, you might even go just do 1. What's wrong with that? Because I'll tell you, and maybe you've heard this story before, but years ago, and I'll make it short, Baidu. It broke out of 80 to the upside. It looked beautiful. The next day, it pulled back. Intraday, I'm looking at the chart. I'm going, this is perfect. It's awesome. It's the most ideal, the most perfect setup for me, for my style of trading. It's broken out. It's pulled back. It's bouncing off of the old resistance, which becomes new support. It's $80. The options are $8 or something like that. I don't remember what they were exactly. I remember looking at it and going, ooh, that's expensive. Back then, this was 05, 06, 10 years ago. And I waited. I said, I'll wait for 2 or 3 hours, and I'll look at it again. I had something to go do. And I came back 2 or 3 hours, and it bounced $4. Oh, man, I missed it. I missed the trade. I can't believe it. 4 days later, it was at 120. The thing ran 50% in 4 days, and I missed it because I didn't want to get on for I missed $4 of the move, and I didn't get on. And I remember thinking, if I would have just picked up one contract, just one contract, I would have made a killing. I think they were going for like $24. I would have made triple my money in 4 days. And so one of the lessons I took away from that is when you recognize that you're fearful, when you recognize that you're scared, when you notice the emotion, adjust to it. And most of the time when the emotion we feel is fear, it's either fear of losing or fear of missing an opportunity, and adjust to that emotion. Because if you're really that scared and that nervous, you might be scared and nervous about taking a loss, but at the same time, you don't want to miss it. And the way to adjust to that emotion is to scale back and do a smaller position, even if it's only one contract. Because I can guarantee you one thing, and I learned this from Baidu, that even if it was one contract, I would have still been happy. No, it wouldn't have been 10 contracts. I wouldn't have made $20,000 in 4 days. I would have made $2,000. But you know what? I would have made $2,000. I made nothing. I sat there and watched it just beat myself to death emotionally because I didn't get on. So don't succumb to the fear, adapt to it. Ooh. I don't know, maybe it's me, but that sounded pretty good. Don't succumb to fear, adapt to it. I'm writing this down. Ha! I don't know, sometimes it just comes out and it sounds great. Maybe that's me, I don't know. Hopefully, my rambling, hopefully you stuck around, because honestly, I think the last 10, 15 minutes was, it's weird. I mean, I've learned something for myself. It's kind of crazy. And like I said, that's why I love doing this. So hopefully this bonus session has been good and beneficial. Significantly longer, about 3 times longer than I had planned, but it's been fun, at least for me. So, and I'm taking away some stuff here that is going to help me too, actually. So anyway, so if you have any other questions, if this brought up questions, hopefully it's solidified and clarified some things for you. If not, feel free to shoot me an email again. Anytime, anything you need. I hope it's fairly obvious that I love doing this. And yeah, so just let me know anytime you need something, and we'll have some fun again. So y'all have a wonderful day, great rest of your week, and we'll see you very soon. Bye-bye.